we think can make a meaningful difference to the drivers of growth and potential output. So measures that boost the participation rate of the population, boost employment, that boosts growth and then boosts tax revenues. Measures in the past that governments have done to boost business investment have also built up the capital stock, increased capital per worker, and we therefore expect to have some impact on productivity. And then finally, most recently, in our last EFO, we looked at reforms to the planning system, and also in the EFO before that, reforms to public investment, both of which we also think can make, ultimately some modest, but if sustained, significant differences to the growth rate of the economy.
Given all of that, given that growth could reduce debt, does it concern you that government is only increasing R&D by 0.7% a year over the next 5 years?
I think these are issues for government. It's always got to make choices and trade-offs about where it spends its money. R&D is one of the things which drives potential output by increasing the stock of intangible capital. So it's one of the things which we would take account of when thinking about the growth potential of the economy. But as I said, there are a number of different levers the government can pull. And it also needs to bear in mind that higher and higher levels of taxes are also not good for growth. So if higher research and development is being funded by a higher tax burden, there are some choices and trade-offs that need to be paid for.
Unless it's funded by debt. But finally, do you think it's responsible for the OBR to have a productivity forecast that is 2/3 higher than the Bank of England, given that implies an extra 50 billion fiscal black hole for the Chancellor if you're wrong?
Well, our productivity forecast is something which we keep under review. We are in the midst at the moment of what we call our supply stock take, where we look at the drivers of the potential output side of the forecast. In the near term, we're reasonably aligned with the Bank of England. In the medium term, there is some difference between ourselves and the bank and some other forecasters. It's an issue which we keep under review. When we look back at our forecasting record over the last 15 years, in general, our GDP forecasts have been pretty much in line with the consensus. As it's turned out, we've both turned out to be wrong, both ourselves and the consensus, because we both turned out to be too optimistic about the outlook for growth. But we come to our own judgments on these kind of things. As I said, we've got a review underway at the moment. When our forecasts entirely align with the Bank of England, people tend to complain that we're all subject to groupthink. When they differ from the Bank of England, people tend to ask, why do you guys differ on the same question? So, so from time to time, we in the bank do diverge. At the moment, we do in the medium term, but it's an issue we keep under review.
Thank you very much, Mr Coughlin. Dr. Cheevan-Sandler, MP.
Thank you, Chair. Mr Hughes, in terms of fiscal risk to debt burden, if we underestimate the growth impact of public investment, it damages our debt burden, right? So if you, the OBR, underestimate the benefit of public investment, it means less investment, it means less growth, and then fundamentally that ends up being the doom loop. Do you believe the OBR currently adequately accounts for the growth impact of public investment?
I think we do. We did a pretty comprehensive survey of the literature on this question. We also looked at what other kind of longer established forecasters apply in terms of elasticities between levels of public investment, levels of the capital stock, and then economic growth in the long run, and the sorts of ratios that we've applied to the contribution of public investment to growth match quite closely what the literature suggests, and also match quite closely what our sister institutions in places like the US and the CBO apply to measures pursued by the federal government. So, as always, we keep these estimates under review. We look at the impact that they're having. I think it's important to not overstate what the government is doing on public investment. I mean, they are in essence keeping it constant as a share of GDP. The previous government's plans were to reduce it somewhat over the next 5 years, but their plans are to keep it more or less constant as a share of GDP, which would continue to support the level of economic activity we've got in the economy. There's not some takeoff in public investment over the next 5 years, which is somehow supporting additional levels of economic activity. They're just not cutting it back as a share of GDP. We did think there was some growth benefit even from maintaining current levels of public investment, but you've got to remember that the government invests about 2 to 3% of GDP per year over the last sort of 15, 20 years. The stock of capital supporting the economy is about 200% of GDP. So it takes quite a long time for the marginal addition to the capital stock being made by the government to make a material difference to the growth prospects of the country. But what we try and show in our forecast is if, over a 5-year period, it makes a modest difference, sort of tenths of a percentage point of GDP. Over a longer period, if you go out 10, 15, 30 years, you can see a bigger difference because that capital stock builds up and builds up over time.
It's fair. I think aside from public investment, also public spending on the other side, which I think, to be fair, I wasn't actually entirely clear in my question. Professor Miles, I want to talk about a specific action of public investment, like public spending. The last time you came for this committee, I think I asked you 3 times why private building in the planning bill would lead to higher growth, but public investment and public building and social housing wouldn't lead to more growth. If I can quote again from page 27 of the EFO, the increase in productivity is driven by the residential planning reforms, which we expect to increase construction sector productivity and housing services due to the higher housing stock. I think the EFO is quite clear that the view of the OBR is that private sector building induced by the planning reforms leads to more growth in the short term. But at the moment in the OBR forecast, in the short term, the same thing isn't true of social house building. Now, last time I asked this question 3 times, I've looked back at the transcript and I don't think I got an answer. Do you have an answer now?
Well, I think that all house building has the potential, whether it's funded by the public sector, local authorities, or by the government, to increase the level of GDP. In a way, it happens almost automatically, because if you increase the stock of housing, in GDP you count either the explicit rent that's paid on housing if it's rental housing, or the implicit rent if properties are owner occupied, and that's part of measured GDP. So there will be an impact. There will be an impact there. So it's not the case that housing that might be in the rental sector and might be funded by local authorities or by government doesn't have an impact on GDP.
So it's specifically within your forecast, because within your forecast you have an increase in, if you like, potential output, which is induced by the planning reforms leading to more private building. What I'm saying to you is at the moment in the EFO, your forecast says if you build more in the private sector, you increase trend productivity growth, you have more space, if you like, both kind of economically and fiscally, but inside the forecast it isn't true of social house building.
Part of the impact on productivity is what I just described, that if you increase the housing stock, just the number of houses, that will show up in GDP. That is in our forecast. There's a different effect, which is that as the planning restrictions allow some land which at the moment you can't build on, for residential purposes, to be built on, there's a productivity impact from simply taking land which at the moment, let's say it's agricultural land, the value of that land and the contribution it makes to GDP just comes from using it, for agricultural purposes, and it might cost, £7,000 or £8,000 an acre. That can turn into 300, 400, 500,000, or even £1 million an acre if you allow residential development. And in fact, that is the bigger boost in our forecasts to productivity that comes from house building. Now, it wouldn't matter whether the houses that were built were public sector housing or private sector housing. You'd still get the boost from taking land that was relatively low productivity, it has sheep on it, to housing, the value of which is clearly much higher, and the income thrown off by the housing, either actual rents or implicit rents, is just much higher. I mean, that's the mechanism in our models.
And the last time, again, I think we came to this where I said there's 1 million houses at the moment that have planning reform but aren't being built, right? So I said to you then, if the public sector was to build houses on there, at the moment the OBR forecast model doesn't say that improves growth in the short term. It doesn't lead to fiscal space. And to the point of the doom loop, in one sense you are undercounting the impact of public investment.
So I'm not quite following
so
the question at this point.
So if I have a piece of land at the moment,
yes,
that I build on social housing, i.e. this land is currently undeveloped,
yes,
but it has planning permission.
Yes.
At the moment in the OBR forecast, if I build social housing
I don't think that's right.
It doesn't lead to more growth.
Like Professor Miles.
I don't think that's correct. I don't think that would be true in the way we model things.
So you're saying that the increase doesn't come from construction then? Because either it comes from construction or it doesn't.
It comes from,
planning permission.
when you construct more houses, they will generate higher measured GDP in the future for the reasons that I explained, because they will throw off either explicit rent or implicit rent if they're owner occupied. That is part of GDP.
Much okay.
Thank
Thank
you,
you, Chair.
Mr. John Glenn, MP.
Yes. Could I start? John Grady is going to ask about pensions later on, but I want to talk about the impact of some of the changes you point to between the transition between DB to DC pensions to the implied changes in the profile of gilts. And I think the OBR says that you push up interest rates on government debt by around 0.8% if the debt level remains around 100% of GDP. Is there any way of avoiding that?
I think it's difficult to avoid the slow sell-off, which will take many decades, from DB pension funds and their ownership of gilts, because DB pension schemes in the private sector are overwhelmingly closed to new inflows, and they're going to run off over time. And at the moment, those DB pension schemes have quite a large holdings of gilts, and it's almost inevitable that will run off gradually over time. Now, it may be replaced as the size of defined contribution pension funds grows to some extent to offset the decline in defined benefit, although defined contribution pension schemes have in the past and continue to hold very many fewer gilts as a percentage of their portfolio than the DB
And they're not
schemes.
obligated to a fixed payment in the same way that DB schemes typically are. It's not inevitable that trajectory would work like that, is it?
Well, I think they would become something different from DC schemes if that were true, since in a sense the defining characteristics in some way of DC schemes is, the money is paid in, it's invested in assets, and those assets are the source of the revenues for the pensions, and if the assets don't do very well, then the pensions paid out will be lower, and if they do really well, they'll be much higher. So they're not fixed, unlike, as you know, of course, with DB schemes. And that's part of the reason why the DB schemes were natural buyers of gilts, because they wanted to try and hedge a fixed obligation to pay pensions against the assets, and DC schemes are not in the same position.
So one of the commentaries I've seen recently suggests that the way that the Debt Management Office operates, with a greater emphasis on long-term linkers, has been expensive for the way that our debt is paid for. I recall as a minister, and I think my colleague Dame Harriet would have done the same, engaging with the market to assess the appetite, and then the DMO essentially does rounds of gilt issuance to reflect that demand pattern. Could you say how we could do things differently going forward, or should have done differently, to avoid the situation that we're in with a disproportionate number of long-term linkers in our profile of debt?
I think I'd say that since index-linked bonds were first issued, which is probably almost 45 years ago in the early 1980s, on the whole they've generated reasonably good value for taxpayers, because the real interest rate on the index-linked bonds, although it was high when they were first issued, actually came down very substantially over that period, and until relatively recently they had a real interest rate of -2 or 3%. So you could lock, the UK government a few years ago, not today but a few years ago, could have locked in at 30, 40-year borrowing at a real interest rate, inflation-adjusted interest rate, which was negative. That's not quite the same today. Those yields have gone back up. They're positive again, and it's not so obvious that they're such great value today. I think the reason why the DMO has actually skewed its issuance slightly away from index-linked bonds recently comes back to the defined benefit pension scheme, who have historically been the big buyers.
Yeah.
And their demand is already beginning to drop off to some extent, and I suspect that will be a trend that will continue into the future. So for good or ill, I think the Debt Management Office, in trying to match what it issues against where the demand is very likely to be issuing a lot fewer index linked in the future.
My final question is, looking at the Chancellor's new debt measure, it generates, I think, 113 billion, which is committed to extra capital expenditure. How do we measure, and how do you account for the return on investment? Where's that reflected, so that the taxpayer watching us today can say, right, where do we look for to see where the ROI is going to be seen in the public accounts as well?
I guess in two places. One is there's the direct financial return that the Exchequer would get from investing in financial instruments. So to the extent that they are lending money or investing in equities, the loans would generate interest as well as repayment of the principal, and then the equities may well appreciate in value and may generate dividends. So the financial assets that are held by things like the National Wealth Fund will generate some kind of direct investment return for the taxpayer. And then there are the potentially indirect benefits from a faster growing economy that you might get if those schemes are invested in if those monies are invested in schemes that sort of boost the growth potential of the economy and boost tax receipts. So there's the indirect effect that you might get from a faster growing economy.
Mr. Hughes, it's not really explicit, is it? I mean, the narrative of the government will be we're investing extra money to fix the mess that was left, invest in productive capacity. But in terms of a consolidated, neat view of the net impact of that investment, it is quite piecemeal and difficult to put together in one place and be assured of what that return is. Is that not a reasonable assertion to make?
I mean, that's right. And I think oftentimes the term investment gets used to cover an awful lot of different things that government does. Sometimes they're talking about direct financial investment. Sure. Sometimes they're talking about building a physical asset like a house or a railway, some of which make money, some of which lose money, depending on the way you regulate the prices and you regulate the rents. And then sometimes they just talk about investment as a general term for spending money on public services, which can include education, health, and everything else. So some of those investments, like financial investments, do generate very direct financial returns to the Exchequer, and those can be measured based on what they charge in terms of interest and how they perform as instruments. Others,
just wondering if you think there's a better way, given the policy shift we've seen, of giving public assurance over the effect of that, such that they can say, well, we voted in this government, they've changed these rules perfectly within their rights to do so, but what's actually consequential of all this extra spending stroke investment? Is there a better way that we could do it, and should you look to evolve a more coherent measure so that the public can have more confidence in it?
We've tried to evolve as quickly as we can, and I think in terms of capturing those direct financial returns, we do have a much beefed up, and you saw in the chapter in the Fiscal Risks and Sustainability Report, a chapter on the balance sheet showing how those investments returns, but also potentially risks, can go, because the government is also taking some risky investments, making some risky loans, and they could lose money. So it's not all about upside necessarily. So in terms of providing much more transparency about the government's financial balance sheet and those direct returns, we are providing a lot more information, and happy to provide even more if you're interested. We've got some people who are very enthusiastic on these issues in our organisation. But also those kind of indirect returns where previously, as forecasters, they were sort of implicit in our economic forecast, but not explicit. We've tried to make them much more transparent and explicit about the way in which we measure the economic effects of government policy, be they things like expansions of childcare and what that does for employment, or whether it's public investment and what that does to boost the capital stock. So I think we do try to answer these kind of questions to the extent that our models and the empirical literature can give you reasonable answers. But if there's more that we can do, we're always in the market for
Thank you very
interesting
much.
ideas.
Thank you very much indeed. Bobby Dean, MP.
Thank you, Chair. In some senses, this is going back to question one, but talking about why the price of UK government debt is so high, it feels like at least one of the reasons is because the markets are starting to worry about the fact that each government says this is what we're going to do over 5 years, and all the good stuff that you're going to be happy about, i.e. getting spending under control, happens in year 3 and 5, but that happens on a rolling basis, and so the market's faith in that strategy ever actually paying off deteriorates. I mean, Chris asked the question, is there such a thing as the right debt level? But should we be doing something about the fact that these are rolling forecasts and take account of the cumulative effect of that?
I think there is one of the things which we highlighted in the report, and you might have noticed one of the charts which shows basically what what was forecast in
It's the
terms.
yellow and green
It is the yellow and green
Yeah,
lines.
yeah, yeah.
It was Ed Conway's
Got it
favourite
in front
on
of me
Sky
right
News.
now, exactly.
They are.
Yeah.
So it basically shows, what government claimed was their plan, which shows debt kind of rising for 2 years and then typically falling for the remaining 3, and then what turned out to happen in practice in outturn, which was that the debt rose and rose and rose. Now, part of that was reversal of planned policy consolidation, be that reversal of planned tax rises or reversal of planned spending cuts. Another part of it was just another shock came along. And so you do have to have some sympathy for policymakers that they've been making fiscal policy in a very volatile environment. So some of that higher debt level is just that COVID came along, the energy shock came along. But another part of it was, once the economy stabilized and the public finances stabilized, there hasn't been a determined effort to reduce the level of debt over time. There has been, in practice and de facto, a willingness to allow its level to get ratcheted up and up over time, and then commit to it getting it to fall on a future date.
And my follow-up question is part of a contributing factor our inflation expectations. So when we had the spending review hearing, we learned obviously that the forecasts of real terms increases in spending are according to inflation remaining at 2%. It frequently seems to be going higher than that, even though we don't expect it to. And governments don't really want to cut spending in real terms, so they're going to keep chasing that inflation figure for the government as well. So is there an inbuilt assumption of that 2% inflation? Is that incorrect, do we think, or do we think we always have to target that because that's what the government targets?
It certainly matters for things that are indexed to inflation, so welfare benefits, the state pension. As I'm sure we'll come on to, the state pension's triple lock has turned out to be a lot more expensive than we thought because inflation has surprised on the upside. And I think because inflation tends to surprise much more on the upside than it ever does on the downside, that can, the triple lock doesn't allow you to take the benefit of it surprising on the downside because of the 2.5% floor. And then for other welfare benefits, it doesn't surprise on the downside to the tune of double digits the way it surprised on the upside more recently. And so that becomes a kind of ratchet for welfare costs. And then for departmental expenditure limits, it's a process of basically the government and the Treasury trying to hold the line on a set of cash budgets while inflationary pressures build up. And I think, and we've kind of seen in recent years that you can hold that line for a little while, and then it tends to pop out the top in the form of either industrial action or continued difficult pay negotiations for government.
Thank you very much, Mr. Dean. John Grady, MP.
Thank you, Dame Meg. I just thought it'd be worth picking up on the rest of the chapter on debt on paragraph 275 of your report, which notes that the switch from DB to DC is likely to lead to a permanent drop in purchases for domestic gilts from around 30% of GDP to 15% by 2070. And what you go on to say is that even at today's debt levels, you're looking at an additional interest bill of £22 billion a year. 2 questions. Could you talk us through how much of a problem this becomes if debt goes on a higher trajectory, as your report suggests it will? And secondly, what are the policy options to government to address this?
Yes, the calculation we did, as you rightly say, was assuming that the amount of debt relative to GDP stays the same, but it's just that there's less demand from the pension sector. And then you've got to find other people who at the moment are not holding those bonds. You've got to induce them to hold them. That almost certainly means you've got to offer them a better deal, a higher interest rate, and that's where that calculation comes from. Of course, that all gets somewhat more tricky if the stock of debt is not staying at 100 and were to be rising, and so that estimate of about 0.8% on the interest rate on government bonds over the long run, it's kind of a slow process in an environment where if the debt were actually rising on top of that, would add to that number. That's in a sense one of the reasons why our projection that given the demands upon government spending and the current system of taxation, there looks like there's going to be, if nothing else changes, a rising level of government spending relative to GDP, a constant tax take at what is already quite a high level, that obviously then generates deficits which add to the stock of debt, hence the simulation which says that if nothing changed, it wouldn't be right to assume that debt just stayed at 100% of GDP. It would indeed be rising over time. And that's ultimately probably in a way that would be unsustainable, because there'd be then a feedback on the interest rates.
And if I've understood the report correctly, in essence what you're saying is if public spending and tax continues on the same trajectory, debt goes up significantly. But look, you've got another problem, that you've lost a big buyer for government debt, and therefore you've kind of got, that is really what you're saying, isn't it? So it becomes unsustainable because you've lost a buyer as well, which causes a real issue.
It's right that there are two separate issues, both of which, as one looks far into the future, are worrisome. One is exactly what you say. It's that one of the strong buyers of UK government debt over the last several decades is going to be declining. And then a separate issue on top, which is the pressure on spending against tax revenues.
Thank you, Professor Miles. I just wonder, Mr. Joseph, you've got a long-standing interest in this, whether you've got anything you'd want to add on this particular topic of losing the DB buyer of gilts and what that means.
Well, I guess one part of the analysis that we do in the report is to consider what that implies in terms of the type of buyers that might have to step in to replace the demand from pension funds. And we do some analysis there based on some studies on the kind of elasticity of different types of the price elasticity of different types of buyers of gilts, and it is basically the case that the defined benefit pension funds have had a kind of structural, if you like, demand for gilts because they match their liabilities so well, whereas the other buyers that you might have to attract into the market could be, for example, overseas buyers who have a much wider range of assets that they can invest in, and therefore are likely essentially to demand a higher price. And that is what leads to this estimate that we have in the report of the increase in gilt yields that might result from this over time. It's kind of long-term process of around 0.8 basis points. I mean, we do highlight in the report, there is a lot of uncertainty around that estimate. It depends on the types of buyers. It also depends on the degree to which this has already been anticipated by the market, so is already in prices, which may well be the case to some degree.
And presumably 0.8 is at 100% of GDP.
Yes.
At 270% of GDP, 0.8 is probably a little low, isn't it?
Yeah, exactly. Yeah. So if debt was rising and you need to attract in even more buyers, then it's likely there would be potentially a bigger effect. Yeah.
Thank you. That's all from me, Dame Meg. Thank you.
Thank you very much, Mr. Grady. Rachel Blinken.
Thank you very much, Chair. Mr. Hughes, in your report, you say that over the past 2 decades, the size and complexity of the government's financial balance sheet has expanded considerably. Since 2004-5, public sector net financial liability has more than doubled from 33% to 83% of GDP last year. So could you elaborate on what you are trying to convey in this report about the financial risks and sustainability of the public sector balance sheet, please?
Yeah, I mean, what's been driving the expansion on the liability side, we've discussed an awful lot, which is basically the government's been issuing lots of debt, mostly in the form of gilt, although it's probably worth highlighting also that one of the phenomenons since 2008 has been some of the gross issuance of gilt by the DMO has been bought up by the Bank of England through its quantitative easing operations and replaced as a liability by the central bank's own liabilities in the form of in the form of Bank of England central bank balances. So just on the liability side, things have gotten more complicated because we're used to on the liability side having sort of boring, long-dated, sometimes index-linked, but generally speaking, long-dated liabilities where the interest rate doesn't change very quickly over time because you're not replacing that much of it that quickly. when the Bank of England came in with QE, it basically replaced a liability with a very long maturity, average 15, 16 years, with an overnight liability. Because central bank deposits at the bank, commercial bank deposits at the Bank of England carry just pay bank rate. So that's already made the liability side of the public sector balance sheet a lot more sensitive to just day-to-day changes in interest rates. And you can see that in our fiscal numbers, right? Our interest costs have just gone up a lot. And that is, first of all, bank rate going up, and then over time, the overall liabilities of the gilt portfolio catching up with what is the market rate of for gilts. So the liability side of the balance sheet has gotten more volatile and more sensitive to interest rate changes. And then the asset side has also sort of become more complicated and possibly, and certainly more risky in the sense that the UK government hasn't typically held very many financial assets. It acquired a bunch during the financial crisis because it bought a bunch of banks, but then over time it has disposed of those. It has also accumulated a large stock of student loans, which have a variable rate of repayments because it depends on the future earnings of students and several other parameters. So the student loan portfolio also carries some risk because you don't ultimately know how much of it's going to be repaid because it depends on what students earn. And then over time, government has also become an active lender in a number of areas. It lends money to businesses. It lends money for energy projects. These sorts of things, and those loans carry risks because businesses can default on the loans, and if the government doesn't get repaid, that also has consequences. So we've tried to illustrate that the government is now targeting the financial balance sheet as one of its fiscal rules. Yeah. There's a lot more sources of things that can go wrong in that than just looking at the debt stock.
Thank you very much. So I wanted to talk with Professor Miles about what this is doing to the model, this growing use that the government has of public financial institutions. How is the model that the OBR is using adapting in order to provide the most effective forecasts it can with this complexity within assets and liabilities?
I mean, you're right, it is complicated because you then have to value the asset side and the balance sheet side, and the asset side and the liability side of the public sector in ways where some of the assets are quite volatile and difficult to judge. Difficult to judge things where there isn't a liquid market, so you don't quite know what proportion of the loans used to finance investment are actually going to be repay in full. Some of the things are easier to value. So, for example, when we moved to public sector net financial liabilities, you bring into the assets and the liability side some defined benefit pension liabilities of local authorities, which is a big number, and their assets. Some of those assets are very easy to value, but they're very volatile. So equities, I think there's something like £500 billion of assets brought in, a high percentage of which are equities. So that gets very volatile, and one needs to assess the riskiness of that as you project forward where overall net liabilities of the public sector might go. On the kind of modelling side of the impact of greater investment that might be encouraged by off-balance sheet financing, we treat that, I mean, if there's some more physical investment in infrastructure, for example, we treat that in the same way as any physical investment in infrastructure. It has the potential to boost growth in the economy and the productive potential of the UK. But the sort of balance sheet challenge for us is that some of the assets are more difficult to value now than when, in a sense, the public sector fiscal target was defined in terms of things that were easier to value. That doesn't mean it's the wrong thing to do, it just makes it more challenging to model it.
So just so I understand, you make an assessment about investment and you use similar type forecasting for anything that you would categorise as investment, but you acknowledge that the complexity of assets and liabilities now does mean that it is slightly more difficult for you to forecast. Is that
I would say that forecasting, the public sector net financial liabilities, which is a wider definition, takes more things in on the balance sheet on the asset and the liability side, is more difficult to finance and will be somewhat more volatile. As I say, that doesn't mean it's not the right thing to do. It just makes it a bit more difficult, a bit more uncertain quite how it will evolve, more subject to shocks. So, for example, I mean, a significant sell-off in the equity market could move the net financial position of local authority defined benefit pension schemes by 20-30 billion pounds. I mean, very quickly.
That means that your job's getting a lot harder. Do you think that's reflected in the level of expectation on OBR forecasts? Mr. Hughes, I think that's for you.
I mean, people seem to have lots of expectations for our forecasts. We've taken on 2 new people to work on these issues. That's for us a significant increase in resources to look at the asset and liability side of the balance sheet. We do work quite closely with the people that oversee the local government pension scheme, the National Wealth Fund, the British Business Bank, who also have to do these kind of projections for their own financial accounts. And the Treasury has put in place a framework for monitoring and evaluating these things. So we work quite closely with the rest of government to try and put these forecasts together. But it's a challenge and it involves judgments and it creates additional risks. And so, one of the reasons why we did a whole chapter on it in this report is just to highlight that those things need to be taken into account and thought about.
Thank you very much, Chair.
Thank you very much, Ms Blake. Lona McAvoy, MP.
Thank you, Chair. Just to go a bit deeper into the report and about the British Business Bank specifically. So you've mentioned in there that the British Business Bank currently expects to lose between 30 and 40% of its loans. And that you're going to be updating the way that you use the methodology to reflect those kind of losses. What sort of impact is that likely to have on the outlook?
There are a number of different ways in which you can treat loans in the way in which these institutions account and we forecast. Where there are portfolios of loans where there looks to be an expectation of significant losses, we do expect to impose, for the ONS to impose some write-down on them, which is the treatment that they've used for student loans, where there is just a significant expectation of not full repayment. And it stands, and some of the British Business Bank's loan portfolio, especially those that are geared towards kind of startup loans and more speculative enterprises, you would expect to also have a pretty significant default rate. And so the ONS is looking at what the right rate to apply to that group of loans would be. We are discussing that with them, and we will reflect that in our forecast, as well as what we think the dynamics are likely to be going forward. At the moment, that portfolio of loans is only a few hundred million, which, I mean, it's a lot of money, but in kind of macro and fiscal terms, where things are denominated in billions and trillions, a write-down on those loans would make a bit of a difference to the outlook for Snuffle, but it's nowhere near making the difference between kind of meeting or missing the government's fiscal rules. The other thing to bear in mind, and coming back to Mr. Dean's point, is that Snuffle's about it falling in the medium term, not about the level. So accounting changes that move the level up and down matter less for whether the government's meeting its rules than whether they affect the trajectory of it over a 5-year period. And if over a 5-year period you expect a sort of constant default rate on the loan portfolio, that doesn't really affect the overall trajectory of where the balance sheet is going. It's only if you expect a kind of increasing default rate over time, or something causes you to change your view of the outlook for these kind of instruments, which gets worse over time, that would make a big difference to how the government has expressed its rule for Snuffle.
Okay, and just on the use of including the losses, do you think it's the right time to be bringing that in, given how much data there was on student loans losses before that was included? Is it appropriate to bring this in now when the government's just invested so much money in the British Business Bank to try and incentivise them? Could it have any negative effects, including this kind of speculative loss?
I think my general philosophy is to recognise information as soon as you've got it, and to not kind of live in denial of these sorts of facts. We know that these, particularly a portfolio loans which are designed for startup enterprises where the business itself is expecting a significant default rate and factoring that into its own accounts and its own financial decision making and its own risk taking. I mean, forecasters should factor that into their forecasts. I think otherwise you're planning on inconsistent bases, and it can create a real risk, which we have seen in the UK and in other countries, that if you have a sort of perverse accounting treatment of something, it encourages the use of that instrument because of the way it's treated, and it can sort of drag resources in favour of loans because people think, oh well, loans always get treated as though they've got full repayment even if they don't, and so. I think you wouldn't want those kind of incentives to be created within either your accounting or your forecasting system.
It just seems strange that which bits sort of speculative losses are included, but then speculative gains in some other areas might not be scored because you haven't seen the evidence and you haven't. And I don't know whether it'll be interesting to see if 30 or 40% is the right amount.
Yeah,
and then we can have that conversation in a year's time.
I guess we have some experience from COVID loans that you saw pretty high default rates on those, and it's important to bear in mind that it's hard to make money on a loan because people aren't going to pay you back more than they borrowed. There can be speculative gains on equities and other kinds of investment, but for these sorts of things, kind of 100% is usually the best you can hope for.
Okay.
Thank you very much. Yuan Yang MP.
Thank you, Chair. And Mr. Hughes, I've noted in your fiscal risks report that you've gone into a bit more detail than usual on the risk of water companies being potentially reclassified as public sector. And as a Southeastern MP, my constituents suffer every month the financial risks of Thames Water, so it's a very live issue for many of us actually on this committee. Do you go into more detail because you're starting to hear more from the ONS about the risks of reclassification? Could you tell me a bit more about how you see that changing over the next year or so?
So I guess it's a few things. We don't just highlight water, we also look at housing associations and higher education institutions, because they're, and I suppose especially for things like water, they are providing an essential service. It is a very heavily regulated sector. It's one where the government is imposing more and more regulations on corporate decision making. And we have seen in the past that at some point, the level of government intrusion into corporate decision-making in a sector gives the government effective control, and then that thing gets reclassified to the public sector. That's what happened with Network Rail. That's what happened with housing associations until the government took some controls off to get them back into the private sector. Oftentimes, that imposition of controls is geared toward managing financial challenges in the sector because the government is putting more money in and they want assurances about getting repaid. And at the moment, we know that the ONS is looking at the classification of the water sector in general, as well as the government has been taking kind of additional interest in some water companies, and there are concerns that some of them might even end up in receivership. And so there are a number of reasons to believe that at some point, either because of a methodological decision of the ONS or because of the financial condition of some water companies, they could end up being taken into public administration. And the point that we wanted to make by illustrating that example here is that once that happens, you've got to pass their balance sheet up into different bits if you want to see what it's going to do to the government's financial balance sheet, because water companies have a lot of debt. They haven't got that many financial assets, so their financial balance sheet impact is quite adverse, but they've got a big network of pipes and reservoirs, which doesn't count toward PSNUFL, and so it can be quite a negative financial balance sheet hit, despite the fact that overall the assets and liabilities of water companies are more or less in balance. It's just their assets are, from a PSNUFL point of view, the wrong kind of assets. They're fixed assets, they're not financial assets.
Just to pick up on that point, you've written before, Mr. Hughes, about the public sector net worth as a target, I think in the 2019 Resolution Foundation paper. And as you describe in the fiscal risks report, there are these significant financial liabilities which are captured in PSNUFL, but also non-financial assets like the pipes and the physical infrastructure, which are not, but would be captured in a broader net worth measure. So looking at all of this, how much does the reclassification of water companies really matter when it comes to things like the debt rule and also to a broader valuation of what the government is looking after?
So I should say I have no official position on what fiscal targets the government should have, regardless of what I may have written in the past. I mean, our jobs as people who run the OBR is to assess whatever fiscal rules the government has, highlight their features and discuss their risks. And what we also try and do is also just is monitor a broad array of indicators of the financial health of government. We have not taken our eye off public sector net debt and the targets that previous governments have used, because we think that really matters. It is really important what you are on the hook to repay your creditors for. This government is also interested in what's happening on the financial side of its balance sheet, wants to make more active use of that. We're happy to look at that. We've got the wherewithal to forecast it, but we also try and highlight both the sort of features and risks of that as a fiscal target. And David was talking through a number of them around valuations. We also forecast public sector net worth, and you can have a look at what that does over time. I guess what's interesting about all of them is that they sort of all more or less do the same thing, which is that debt's gone up, financial liabilities have gone up, and net worth has gone down, all pretty much in the same direction, all for pretty much the same reason, which is government's been running a big current deficit and it's been funding it by issuing gilts, and everything else has kind of bumped along in the background.
Yeah, and are you currently making preparations to forecast the financial liabilities of water companies in terms of getting ready for potential reclassification? Could you talk us through what would be the different steps of that in the next few years if something like that did happen?
I mean, we try and be ready for anything. I'm certainly not signaling that this is imminent or that it will happen ever. But what we try and do is keep an eye on where the risks are around the government's perimeter, because we know that the ONS can make sudden and dramatic decisions. If it's coming up to a time when we have to do a forecast, we want to be able to consolidate those with our forecast and kind of easily reflect them in the way in which we do our financial projections. So we're kind of always surveilling the boundary of the state, as it were, to look at where the kind of risks are. We did that a lot with Network Rail back in the day. We did it a lot with housing associations. With this chapter, we would basically just also wanted to highlight who at the moment is camped out on that frontier at the moment, and what would the risks be if some or all of them were to find their way into the public sector.
So do you have a view as to how FSNFL would change over the next few years if any particular water companies were reclassified?
I mean, my sense is it would be a level effect, primarily, rather than one that would materially affect the trajectory of FSNFL. And as I said, and because the target is about the trajectory in year 5 at the moment, stuff that moves the level up and down is less exciting. But that does depend a bit on the structure of the water company's debt and whether they're paying a much higher interest rate than the rest of government. That's not the case at the moment, but it depends on what terms they start to borrow in future.
Thank you.
Thank you very much, Ms Young. Bobby Dean, MP.
Just a quick follow-up. You mentioned about the significant impact it would have on FSNFL, but it would have a lesser impact on if you move to a different set of fiscal rules, public sector net worth. So I guess if you were to bring the water companies onto the balance sheet, you'd say, well, the obvious thing to do is to switch to that rule. But what would be the advantages and disadvantages of doing that?
Well, as I said, we forecast whatever rule the government's got. I'm not sure it would be an obvious thing to do to suddenly start focusing on net worth just because the water companies have come in. I mean, water companies are important, but
so some may argue that that's a way to solve the problem.
In the end, they add a few tens of billions one way or the other to a balance sheet which has got trillions on either side. There are pros and cons to any fiscal measure, and the pros of net worth is it's a more comprehensive picture. The cons are that quite a lot of fixed assets of government don't yield any kind of serious financial return to government, and so to think of them as being something which can somehow pay for the debt that is issued to finance them may not be the right way of thinking about things. Government assets are not like corporate assets. They're not all there delivering earnings for the business in future. A lot of them are just delivering well-being for citizens, and they're important and they're good. But government spends a lot of money on military equipment. That's important to keeping our country the way we like it, and with the borders that it's got. But that's not somehow generating a financial return which is going to pay you back for having all that military equipment at your disposal.
Thank you, Mr. Dean. Mr. Corbyn,
thank you. Mr. Hughes, just on that, obviously a key part of the government strategy is around defence R&D, which economic forecasts show does increase economic growth. In fact, it's one of the most significant ways of increasing economic growth. So would you agree that, in fact, if provided they are spending it on defence R&D, it is a good use of government money for boosting growth?
I mean, to the extent that it feeds into the government's contribution to the capital stock as an intangible asset, for us, that would be one of the things which goes into our calculation of the driver's potential output. So I think I'd put it that way.
Thank you. John Glenn, MP.
Yes. when you look at the fiscal risk register in your reports, they paint quite a gloomy picture, and persistently so. I mean, I think last week you said that there's a trend of debt ratcheting ever upward, and you see debt as a percentage of GDP going up a further 5% over the next 5 years. I mean, in the absence of improved economic growth, it's difficult to see any change in this trajectory. Is that the right conclusion to draw?
I mean, governments have policy choices as well, right? They don't just have to hope that the economy does better. They can make sure that they've got the debt level they feel is secure and prepares them for future shocks. It's certainly been the case that since we started producing these reports in 2017, we've been hit by a lot has happened since then, and most of it has been bad. COVID, has delivered a big shock to the government that raised debt. The war in Ukraine further added to our stock of debt. We've seen disappointing economic growth, and more recently we've seen a very dramatic and rapid rise in interest rates on that much higher stock of debt. So all of that has put the public finances under a lot of stress, and so you can understand why governments have found it difficult to then deliver the kind of fiscal consolidation that gets debt falling again and rebuilds some fiscal space. But I guess the thing that is concerning, if you look at report after report that we've produced, is that the number of risks have mounted over time. We've had war starting in Europe again. We've got a US administration that is putting tariffs on everybody, although we've managed to carve out a few exemptions for ourselves. So global risks are rising, and our capacity to absorb them has been shrinking because we've ended up having to spend an awful lot to deal with those risks.
Let's then look at what governments can do. I mean, I think we'd all agree that your assessment of what's happened over the last 7 or 8 years is quite, or 10 years is quite significant. But in the spring statement, you were criticised for not having performed the productivity impact of cutting welfare spending within the time to make it into the forecast. That proved to be actually a pretty good judgment given the decisions of Parliament last week. I think, though, there is concern over exactly how you make the judgment, and my colleague Lola McAvoy touched on this a bit, around the arbitration point on what you include and what you don't include. So some pieces of legislation, like the Employment Rights Act, will have an impact assessment of nearly 5 billion. There's a range within that. There'll be different pieces of legislation will be at different stages across the Commons and Lords. Can you explicitly sort of nail for us who makes that judgment? Is it the Treasury? Is it yourself? What's the sort of cutting off point? I think you said you received data very late. The Prime Minister, I think, at the Liaison Committee, I believe, was critical that it wasn't scored. Is there anything you'd like to say about how that process works across Whitehall?
Let me make some general points about how we deal with what we call supply-side effects of policies, which can be their employment impacts, their investment impacts, their growth impacts, and then Mr. Joseph might want to say a bit about the specifics of the case in welfare.
Thank you.
What we need first of all from government is a policy, and if the government doesn't have a policy they can explain to us, we can't put that in our forecasts. In the case of the welfare reforms, the benefits came to us very late and past the deadlines that the Treasury had set. The employment support program, there were no specifics. They couldn't tell us who was going to benefit from this program, which groups, what kind of support they were going to get. There was no policy for us to score in our forecast. So in terms of taking into account of the employment effects of that policy, the detail was not there. Once we have the details, there's then a further set of judgments that we have to make about, and we apply a set of criteria which we set out in a paper we published 2 years ago, which is the policy, if it's going to have a supply side effect, is it a significant policy? Is it going to have additional effects beyond kind of what is the ordinary day-to-day business of government? Is it going to have a durable effect? So it's not just a kind of one-off policy, it's something which is going to last for a period of years and support potential output in future. And then, most important, and in some cases most challenging, is there evidence to support, what the government is claiming is going to be the long-term economic effect of the policy. Where those criteria have all been satisfied, there's a clearly defined policy and those other things. We have from time to time reflected those on the supply side of our forecast because people have asked us to, and people have said, you guys cannot be growth nihilists. What kind of government policies can have an impact on growth? And both under the previous governments and under this government, we've done that. In the case of the welfare issue, our main issue on the employment support policy was that the policy was not defined. So the rest of those questions didn't enter into it because you couldn't answer them. In terms of the specific timings, Tom, you might want to say more.
Can I just ask a bit, if we just go back to the welfare question. I think in your report last week you say if the current gateway of onboarding people continues, there'll be 12 billion extra on welfare by 29-30 than at the current time. Do you have quantified options of what choices Parliament and government could make that would address that? Because part of it, the problem here is that you are making a commentary on as is. You studiously, understandably, because that's what you're legislated to do, refrain from making policy judgments. But perhaps it would be helpful for those watching to understand what choices could have been made that would ease that pressure and stop it going up even further than you predicted in the previous report.
We're definitely legally prohibited for answering the second part of that question, which is we are prohibited from providing alternative options to government policy. We can only score the impact of government policy. But Tom and colleagues at the OBR have done lots of work on what has been driving those trends in rising spending on and claimant numbers in disability
perhaps
benefits.
we can then draw our conclusions over what we might need to do.
I think that's the only legal way to do it, I'm afraid.
Mr. Joseph.
So yeah, thanks. Well, so just to explain the 12 billion number that you referred to in the report. So in our forecast for incapacity and disability benefits, we've seen a huge increase in caseload since COVID, about 1 million extra people on the caseload, about £20 billion of extra spending. And in the baseline forecast in March, even including the policy changes the government had announced at that time, spending was still forecast to increase by a further 15 billion. So still a big pressure from those benefits on the public finances. That forecast was based on an assumption, a judgment we had made, that some of the growth in the caseload we've seen since COVID is essentially been due to cost of living pressures, pushing people into the more generous benefits. And we made a judgment that once in our forecast cost of living pressures ease off, some of that caseload growth will also ease off. The 12 billion number in the report was the estimate of the risk if that judgment turns out to be wrong and actually caseload increases at the same rate we've seen since COVID, an extra £12 billion worth of spending. I think it's definitely worth saying that one of the reasons we highlighted that risk is because the drivers of this big increase in caseloads that we've seen is quite uncertain. It is probably a combination of changes in underlying health of the population, working age population deteriorating, a combination of sort of changes in the labour market, cost of living pressures, but also structural factors in the benefit system itself.
But do you identify? Sorry, can I just add on that specific point? Do you identify challenges derived from the different pathway for mental health, for example, as a specific particular challenge in terms of the volume and cost of the welfare of?
Well, so it's difficult to isolate the specific costs of that driver, but we've certainly highlighted it in some of the analysis we've done as one of the most important drivers of the additional caseload, increasing mental health issues, especially amongst younger people.
Thank you.
Thank you very much, Mr. Glenn. Harriet Baldwin.
Thank you, Chair. I have to say, when I read your fiscal risks and sustainability report this time, I immediately thought of that Hemingway quote about how did you go bankrupt? 2 ways, first gradually and then suddenly. And I thought that the report really looked like we had entered the suddenly phase. And so I wanted to ask you about one of the things that you scored in your 2024 report, which appears to be sort of suddenly changing. And that is the very high risk you allocated to scoring the change to the taxation of non-domiciled residents in the UK. And you put it in the category of there's really, really high uncertainty around this about the behavioural changes. You scored specifically for the change to charging inheritance tax on worldwide assets as being about 0.1 in terms of revenue over the next few years. It does seem to be one of those things, according to media reports, that is suddenly changing behaviour. And does the Office for Budget Responsibility have any way of pulling a ripcord and saying, help, we think we got this one wrong, our central assumption is clearly not right, this is going to cost the Treasury a lot more than we thought, please do something, Mr. Josephs?
Thank you. So, well, as you say, you're absolutely right. We've highlighted that this is a very uncertain costing. It affects a relatively small group of taxpayers and ones which are likely to have large behavioural response to tax changes. We will not be updating the costing of that until the next fiscal event, and I think it is the case at the moment that there is no real hard evidence on the impact that it is having, and it's quite likely there won't be any hard evidence for quite some time until we actually get firm outturn data on from HMRC. In the reforms that the previous government made in their final fiscal event, we assumed that there would be a migration response to the non-DOMS regime changes of around 10 to 20%. So, i.e. 10 to 20% of non-DOMs would leave the country as a result of those reforms. We then changed that assumption in October on the basis of the changes that the current government made, in particular in respect of inheritance tax. We increased it to sort of 12 to 25% of non-DOMs leaving as a result of the reforms. So quite a substantial migration assumption is already assumed in the costing. The 25% number essentially refers to the very highest wealth individuals, ones who have trusts. The 12% refers to those without trusts. So a pretty big assumption, a pretty big migration assumption is already baked into that costing. As I say, I don't think we will really have any hard evidence on the actual outcome for quite some time.
It could all have left by the time you get the actual numbers, is really what I'm hearing you say.
Well, no, what I'm saying is that we won't have any hard data on the actual numbers that have left until we get the tax returns. I mean, even at that point, it's probably going to be quite difficult to isolate the impacts of this specific policy change against lots of other factors that affect location decisions from this group, who are obviously a very highly mobile group of individuals.
And what comparators would you use, though, for a normal year where non-DOMs, because they're highly mobile people with assets all over the world, potentially, or in the high extreme, compared with, can you isolate the impacts of
well, I think we will try very hard and work with HMRC to try and isolate the impact of these policies. But I say there is a lot of turnover in this population anyway, so it will be likely quite difficult. I mean, we based those migration assumptions on the behaviour we saw in the previous set of reforms in 2017. When actually the response was less large than quite a lot of people were expecting.
In terms of what you scored for, anecdotally, the inheritance tax changes, which seem to be having the biggest impact in terms of people's location decisions, was 0.1 every year in terms of the net. So it's not a huge revenue inbound, but you've not got any way that you can sort of pull the emergency cord and warn the Treasury about potentially these assumptions.
Well, that's not tested. So we do our costings updates at fiscal events, and at that point we'll assess whatever evidence there is then.
Thank you very much, Dame Harriet. Dr. Jean Sander, MB.
Thank Thank you very much. I had a very quick question, if I may, Mr. Hughes, about the climate risks you point to. Can I also just commend the OBR on the work on this, because it's been incredibly useful in the debate, as well as setting out the investments and the costs. From where I'm sitting, it looks like around we're having a lot of damage going forward that are accounted for in the cost of transition, which are accounted for. But the productivity benefits of the transition, investment in skills, clean energy reducing the marginal price, more capital per worker, all of those benefits don't seem to be included in the productivity estimates of future growth. Is that a fair reading of where it is at the moment?
Tom might want to say more, but I can have a first go, which is, I mean, when we look at the cost of net zero transition, the cost of climate damage, generally speaking, the cost of climate damage seems to be going up. Net zero seems to be getting cheaper for a whole host of reasons relative to our previous estimates. In terms of whether you could make the net zero transition even cheaper by getting some sort of economic productivity dividend, we don't assume that in the way in which we do our projections. For a number of reasons, partly no serious climate economist can give us a number, and we're definitely not climate economists in the OBR, and so we rely an awful lot on empirical estimates that come from the literature, in particular people who can do it for the UK economy, not for some other economy with a different configuration of energy supply and other things. The second thing is, if you think back, we are more or less leading the charge in carbon reductions in the UK and have been for decades, and our productivity has been going down. So there isn't an obvious correlation in recent history between making the transition to net zero and boosting productivity. Now, I'm not saying one is the cause of the other. I'm not saying that. But what you haven't seen is being ahead of other countries in the net zero transition, putting us ahead of other countries in terms of in the sort of great race to make our economies productive again. So that relationship doesn't emerge obviously from the data. We've asked other experts around who are much more expert in climate economics than us, if there were a fair number to put into our forecasts or even into some scenarios, what would that number be? And I should say there are people on either side of that debate, right? There are people who say the net zero transition is going to be good for productivity because it's going to make the unit cost of energy lower. There are other people on the other side of the argument who say it's going to make the economy less productive because you're just basically, for a period of time, raising the unit cost of energy that you currently use because it's still mostly from fossil fuels. And that's going to hurt energy-intensive businesses. It's going to squeeze margins in any business who's got to keep the lights on, and that's going to have an adverse effect on their investment and other things. In the end, we've ended up in a sort of unsatisfactory neutral position of saying we don't know which side of this debate is going to turn out to be right. But for the moment, nobody's made a persuasive case one way or the other, and there's not much in history that can give you a positive correlation between reducing your emissions and boosting your productivity.
Isn't this part of the worry, though? It goes to the wider point about non-quantifiable benefits. I think in the post-war period, there was huge investment that led to huge productivity gains at that moment. But if at that point we had the OBR, it'd be very difficult to see we could invest in anything because people would have said, well, there's not going to be a benefit. But to the point about energy costs, I just want to have one slight clarification point, if I may. I'm a little bit confused when you say it won't improve productivity. So at the moment, you're right, we've built out on clean energy the one side, but on the other side we've still got a lot of natural gas, which is therefore always setting the marginal price. And the reason why we have such high industrial energy prices is precisely because the natural gas is setting the marginal price. So I suppose we accept the fact that if you get off natural gas for some of your marginal pricing, you're going to have lower energy bills. Wouldn't that lead to a productivity improvement?
I mean, it depends. Part of it depends on how much you need to pay for storage, because the problem with wind and solar is it's intermittent. So how much are you paying for storage, and what does that do to the unit cost? If you're getting your base load from nuclear, we know nuclear is very expensive and can drive up the unit cost of energy system wide. So, and then in other areas like heating, you can move your gas boiler to a heat pump. That heats your house in a less dirty way, but it doesn't do any better. It just keeps your house warm. So it's not obvious that you're getting some kind of disposable income benefit from that transition either. And people are spending a lot of money to switch from one to the other. So that's why we've ended up in a sort of, on this particular question, that's why we ended up on a sort of neutral position. I mean, it's not correct to characterise us as saying we don't believe in the growth effects of public investment. We do believe in the growth effects of public investment, and that's exactly, as we discussed earlier, reflected in our forecasts.
Thank you. I think in the interest of time, Chair.
Thank you very much, Dr. Sender. Dame Harry-Corbin.
Yeah, thank you, Chair. I mean, another place where we're going to suddenly start losing revenues is fuel duty. So I just wanted to clarify, in the current numbers that you have, the projection that you have, the temporary 5p reduction in fuel duty ends when?
I believe that ends next spring.
I believe it does, yes. And where is the inflection point where it's just going to have such a major impact that we no longer have as many petrol cars on the roads, that chancellors are going to have to step in and do something? Mr. Josephs.
Well, so as you've mentioned, in our analysis of the long-term costs of the transition to net zero for government, fuel duty is the loss of fuel duty is essentially the biggest loss, amounts to around 2/3 of the total cost.
Clearly a chancellor is going to have to do something.
We have a scenario in the report actually which looks at how you could reduce the cost of that transition if you were to both sort of choose a policy path, and the decision on policy path is obviously up to government, but to illustrate the risk, a policy path where governments spend less on the transition, choose to use other tools such as regulation or taxation, and replace fuel duty with, potentially another motoring tax, almost halves the cost in terms of the impact on debt of the transition to net zero in our scenarios. It is also the case, even over the medium-term forecast, that you can start to see the impact of the loss of revenue from electric vehicles. So even with the assumption that we have to have in our forecast that fuel duty rises in line with RPI, by the end of the forecast, fuel duty starts to fall as a share of GDP because of the increased electrification.
So what year is that, just for
I think from memory it's right at the end of the current forecast.
What year
it's
is
like
that?
29-30. Yeah.
But all other things being equal, if the Chancellor doesn't make a decision in this year's fiscal event, fuel duty will go up 5p next spring.
That is the assumption in the forecast, yeah.
There is a very small unit in the Treasury that's looking at some of these green taxes. Do you have any engagement with them? I mean, it's quite a small number of people.
So do we have any engagement, did you say, with the unit in the Treasury?
Yeah, because we talked, I mean, you obviously only discuss actual government policy, but there is a team in the Treasury looking at this issue of what is a green tax and how do you deal with the fuel duty issue.
I think we sort of on principle don't discuss our engagement with Treasury on policy issues ahead of fiscal.
Okay, well, we'll come. Good try. Yeah, John Grady MP.
Yeah, so Mr. Josephs, imagine you've come with me to meet a bunch of kind of late 20s, early 30s people in my constituency to talk about pensions. And they're all telling you that you've got the state pension, they're putting a bit into their pension. The self-employed couple in the corner aren't. Could you talk us through what you see as the main problems of our current pension system from a point of view of sustainability of public finances and also securing that group of 20 and 30-year-olds have a comfortable retirement?
Sure. So, well, the risks that we highlight in terms of long-term sustainability from the pension system are driven by three things. So we look at state pensions where the demographic trends and the ageing population mean that on the basis of current policy, state pension spending would increase over time by about a 1.5% of GDP, which is the kind of second biggest source of upward pressure on spending over the long term after healthcare. We also look at the risks to that around the triple lock and show that basically the triple lock is not only a sort of source of pressure, it's a source of risk. And if we have a scenario similar to the one we've seen since 2010, where we've had much more volatile inflation than we had previously and lower earnings, and project that out, then the triple lock adds on top of the sort of baseline projection, around another 1.5% of GDP pressure on the public finances. So that, you know, is a substantial pressure on the public finances over that time frame. The second risk we look at goes to your point on kind of self-employed. The transition from DB to DC pensions and auto-enrolment has meant that a lot more people than previously are now saving for a private pension. Sorry, I've now moved from state pension to private pension, so a lot more people are saving for private pension. But there is quite a lot of evidence, and here we drew on studies by the IFS and DWP and others, that quite a number of groups look like they might not be saving enough to give them an adequate pension in retirement. And there are some particular groups, self-employed is one, that are not taking up private pensions to the same degree as others. That's not necessarily a direct risk to the public finances, but it does create some risk that in the future the government might have to provide more support to those sort of groups when they reach retirement. And then the final risk we highlight is the one we talked earlier around the decline of the DB sector.
And just on because with the decline in DB, people move to DC, they bear the investment risk.
Yeah.
You've identified one factor which drives up the non-pension benefits bill for pensioners in your report is housing benefit for pensioners because home ownership's dropped. Yeah. But presumably that's another risk, isn't it, with the switch from DB to DC, if people aren't saving enough, that actually there's additional pressure on the government budget so that people have, you know, a reasonable minimum living standard.
Yeah, no, so you're right. So that's another group that we highlight in the report. Again, drawing on the IFS analysis that shows that people in private rented accommodation are projected to have less adequate retirement incomes than other groups, and that could create pressure on the housing benefit bill for future governments, or also just pressure to provide wider support in the future.
And in 2070, you show 7.7% or so on the pension, 1.3% on pensioner benefits, e.g. housing benefits. That gets you to 9% or so of GDP being spent on pensions and pensioner benefits. Is that sustainable?
Well, I mean, the picture we are presenting overall when we do our long-term projections is one of debt on an unsustainable path. And the main contributors to that are the fact that there are a number of elements of spending that, on the basis of the current policy settings and demographic assumptions, put upward pressure on spending, while tax as a share of GDP is projected to be broadly stable or slightly falling because of the loss of fuel duty. So it's the combination of pressures on spending from a number of sources, of which pensions is a big one, that creates this gap.
And this combination, how material is the pensions element?
I say, after health care, it's the second biggest contributor to the increase in spending over our long-term projections.
And I suspect you're going to politely decline the offer to set out some options that the government could look at to make this more sustainable.
So again, we're not here to comment on policy, but we do provide different scenarios in the report around the impact of the different factors that contribute to this increase. So demographics is one, the triple lock is obviously one. We also look at the impact that the state changes to the state pension age have, so increases to the state pension age. Over the long term, that actually makes quite a considerable difference in terms of reducing the pressure from state pension spending over time. It lowers it by about 1% of GDP in total, so we assume 3 increases in the state pension age over that 50-year projection.
Thank you.
Thank you very much, Mr. Grady. Certainly a very important long-term issue. We're now bringing to a conclusion this part of our hearing today, so order. Order, order. Welcome back to the Treasury Select Committee on Tuesday the 15th of July 2025. We are now meeting to discuss the reappointment of Richard Hughes as Chief Executive of the Office for Budget Responsibility. Mr Hughes was first appointed during COVID in 2020. He's held the post for 5 years, and this is a 5-year reappointment. And you've indicated in your questionnaire, for which many thanks, that you do intend to serve a full term. Obviously, the OBR's had a bit of a buffeting. Just a year ago, 30th of July last year, the new government introduced the Budget Responsibility Act, which gave you even more powers, particularly that if there are two or more that you provide a fiscal statement if there's a measure which is fiscally significant, or two or more measures where any combination of the measures is fiscally significant. So quite a lot of powers, and now we've heard a lot of discussion, the IMF talking about you doing only one forecast a year, some MPs saying you need to get back in your box, or do only one forecast a year, and some people have been critical of what you've chosen to score. How have you found the last year, and do you recognise that characterisation?
It's been a pretty busy 5 years, I would say, in that I started in the midst of the pandemic and spent a lot of time talking to epidemiologists about where they thought the pandemic was going to go, vaccine specialists on when the vaccine might roll out, the government about where the furlough scheme and the business support schemes were going to go, and trying to understand what that meant for the economy and public finances. Then a few years dealing with the energy crisis and how that filtered through to inflation, disposable incomes, consumption. More recently have been having to contend with what tariffs might do to the UK economy. So I guess in some ways it's felt fairly relentless. I'm not sure the last year has felt that much different from the first 4.
I think the other thing was events, dear boy, events, wasn't it? With the COVID, energy shocks, the war in Russia, war in Ukraine, and but the Budget Responsibility Act was passed by a government as a political move to counterbalance what happened in the budget of September 22, and so giving you more powers. And yet, within a year, there's been quite a lot of criticism. How has that felt for you personally?
I think, we do a job of highlighting this sort of state of the public finances and their trajectory. The reality is that they have been under pressure and stress ever since I've been in this job. And I think what that does is transfer those pressures and stresses onto policymakers who then have to deal with the consequences of it. I don't take any of the criticisms of the OBR personally, nor do any of the staff that I have. I think to some extent, because what we do is portray what is quite a difficult and challenging set of circumstances that both the previous government and this government have had to contend with, and quite a volatile external environment which rapidly translates, for all the reasons we've discussed in this committee, into a revised outlook for the public finances. That creates a lot of volatility and puts a lot of pressure on the policy-making process. I think sometimes frustration with both the constrained state of the public finances and the volatile nature of the external environment kind of translates into basically blaming the messenger rather than not being happy with the message. And I think to some extent that comes with the territory where people criticize our methodologies. We try to address and respond to those criticisms where we think that they're reasonable, and where we think we can do something different. And I kind of highlighted the work that we've done on trying to be more transparent about how we think about the growth impacts of policy measures, where we've identified gaps in the way we do things. We've had discussions at this committee before around the forecasting of departmental expenditure, and the sort of the shortcomings that we've seen in that system, which we've looked to improve in more recent forecasts. So we do try and address where we think that there are legitimate gaps in the way in our methodologies, where we're just being sort of criticised for telling it like it is. Well, that's fine, but it's not going to stop us from telling it like it is.
Okay, well, Mr. Glenn earlier talked to you about how you make decisions about what to include and what not to include in your forecasts, and obviously there's some issues around timetabling sometimes about how things came in. Have you had any discussions with the Treasury about changing the Memorandum of Understanding about how you deal with that, or is that just an iterative process that you go through with the Treasury each time you do a forecast?
So it is codified in the Memorandum of Understanding, and we do discuss and agree the timetable for forecasting with the Treasury, but also with our other key forecasting partners, HMRC and DWP, and other departments, and try and strike the right balance between providing a sufficient number of pre-measures rounds so that the government has a sense of kind of where the pre-measures position is heading, and then sufficient numbers of post-measures rounds so the government gets one, but usually two looks at how things stack up after their policy measures have been fully incorporated into the forecast. Inevitably, there's a trade-off there about kind of when you close the pre-measures forecast, what data's got in, and then ultimately the day of the budget or other fiscal event. And because we are operating in a very volatile environment, you can get changes in interest rates, changes in energy prices, changes in the Donald Trump's tariffs in the middle of all that, and so you have to kind of decide at what point do you kind of stop the music on changing the pre-measures forecast and just reflect the effect of government policy. So you've got a transparent picture of what are the changes we've made to our forecast and what are the changes governments have made to policy, and not try to mix those two things up. That's the discussion that we have in the Treasury around the timetables for the two forecasts that we do every year, and we always come to some kind of agreement at the beginning and then reflect on the lessons afterwards.
I mean, because you've talked a lot in the previous session about not scoring a policy till it's a clear policy, not scoring something until a plan for delivery is properly in place. So on the issue of the welfare reforms and the scoring of people going into work as a result of those changes, while I think you were right that there wasn't detail about some of those work programmes, there's quite a lot of history of work programmes, and roughly if you get 5% of people in a work programme into work, that's it's a good successful one. Did you ever consider an approximation of that, given and what pressure did you put on the government to come back with proper plans to be able to score it? I mean, how does that process work? Do you just say no, or do you say, hang on, if you give us a bit more, we can actually think about scoring this? So
it's never just a straight no. It's always, if you can give us a bit more, we can try and reflect. If you can tell us more about the policy, and that's the policy you announce, equally importantly on budget day, we can try and think about what economic effects it might have. And certainly, under the previous government, there were employment programs where we scored employment effects from sort of welfare to work measures backed up by employment support. So where we were given sufficient detail about the natures of the intervention, the numbers of people being affected, the timetable over which that was going to unfold, and I shouldn't understate this point about additionality, which is how can we make sure this is extra stuff that Job Centre Plus is doing, not just a thing that's going to replace an existing policy of Job Centre Plus, which is going to mean other people aren't getting supported into work. And also that there's a very clear evidence base of the effectiveness of this policy, because as you say, depending on the group that you're talking about, you can see success rates of as low as kind of 10, 15% in terms of proportions of people who are actually back, who are still in employment in 5 years' time. And so those kind of measures of effectiveness need to come from some kind of empirical studies from somewhere. We like to see them from the UK because we like to understand how policy works in our own jurisdiction. Where there's a reasonably analogous intervention in other countries with a sufficiently robust evaluation, we try and draw on that kind of evidence. And so in the past we have drawn on evaluations done of other countries' employment programs, which we think look quite a lot like what the government seems to be announcing here. I mean, in the case of the welfare reforms back in March, as I said, the biggest problem with the employment support, well, there were two problems. One is that the entire policy package came to us very late in the day, even the benefit changes, and there was just not enough specificity about the employment policy for us to really do anything with, other than reflect its costs and say, tell us what you think is going to be the employment impact of this thing.
Okay, thank you very much indeed. Dr. Jevons, Andrew MP.
Thank you very much, Chair. Look, the OBR has to make judgment call on forecasting. It's really, really difficult to do so. Productivity in particular is a key forecast. Obviously, very much hits the fiscal forecast as well. I'm going to present some of the autumn budget EFO forecast, see what the outturn for the years have been. So in 2021, you predicted 0.5% productivity growth, outturn was 1.5%. In 2022, you predicted 0.3%, outturn was 0.9%. And then in 23 and 24, productivity missed on the low side by almost a percentage point at that point. Clearly big sensitivities. What are the big misses I think within year? What's been the miss and why do you think it's missed?
I mean, productivity, you're dividing the entire output of the economy by the entire hours worked in the economy. And so it's the difference between two numbers which over that period were changing enormously because you had the pandemic, which affected both output and hours. Then you had the recovery from the pandemic, and all of us were trying to predict how quickly that was going to happen. And then you had the energy crisis, which hit energy-intensive businesses, some of which are the most productive enterprises in the economy, quite hard. Also, what goes into productivity calculations is the National Health Service, where its productivity is measured directly from the Office for National Statistics, and so the performance of the public services also feeds into those calculations. The misses you've described are, were symmetric either way. So that would suggest that at least in recent years there hasn't been a bias one way or the other. But how productive the economy was going to be after you'd sent about half of people out of the workforce during furlough and then brought them back, massively disrupted the operations of the NHS and other public services, and then tried to turn them back on, was a very hard thing to predict, because you saw a very dramatic fall in productivity, and then you had to ask yourself, how quickly is it going to recover back to its pre-pandemic trend, and then what kind of trend is it going to be on after that? And then we got hit by an energy crisis along the way. So those are tricky judgments. It's also worth bearing in mind that over this period we had a big influx of migrants into the workforce, and a whole bunch of people falling out of the workforce. So thinking about the average productivity of the people who are coming into the workforce versus leaving made a difference. And then sort of last but not least, our various data collection mechanisms were also breaking down over this period because the labour force survey started to become unreliable. GDP measures, as you might recall, were getting, like, the level of GDP was being massively revised by the ONS coming out of the pandemic, as it was in lots of other countries. That's not a specific criticism of the ONS, but you were trying to it was hard to take definitive reads from any one bit of data, and lots of bits of data were changing quite quickly.
And then let's look at before the pandemic. So we've had to say that post-pandemic issues, but also before the pandemic, the OBR did keep getting it wrong. I suppose my concern is that it kept getting it wrong in the same direction. So during the period of fiscal consolidation in the 2010s, we have large negative output gaps and productivity consistently over forecast. 21-22, high public spending, a positive output gap. Fiscal consolidation then back in 23-24, productivity then missing on the downside. The question I'm asking you is this: if you change your fiscal demand multiplier, would your productivity forecast and your GDP forecast be more accurate?
So we keep our multipliers under review. They're based on the ones that have empirically been observed between different kinds of public spending and tax measures and output. The last time we did a review of them, and we talked to people who estimate these models, they turned out to be in roughly the right place. I mean, more generally, when you look back at our forecasting record for both the economy and the public finances, we did one of the things that I asked for, and we published a few years ago, was just a comprehensive assessment of how our forecasting record compares to those of other forecasters, both UK forecasters, other official forecasters like the Bank of England, and external forecasters, official forecasters elsewhere in Europe. And in the end, our forecasting record compares pretty favourably to all of those comparators, especially when you bear in mind the legal constraints we're under, which is that we have to forecast government policy as it's given. We know there are already lots of things in there which probably aren't going to happen, like indexation of fuels duty, so that's already going to make bits of our fiscal forecast wrong. Other forecasters can take this into account, which we can't. But a comprehensive evaluation of our forecasting record against others shows that we do a pretty decent job. Everybody has been too optimistic about productivity since the financial crisis, because everybody was assuming a stronger rebound in productivity after 2008 to 2010, which just didn't materialize. And the issue is at what point people kind of recognize that and just revise down their medium-term forecast of productivity, which we did in the middle of that period. But as I said, kind of optimism was something which affected all forecasters during that period, because we just didn't realize what a legacy the financial crisis and then subsequent shocks had for productivity.
That was great, but the question I actually asked was more about if you change the fiscal demand multiplier, i.e. my contention is that there was cuts in public spending that hit productivity in a number of different ways that can't be accounted for in a very hard to quantify model, as we've come to several times today. I appreciate everyone's got it wrong, but your forecasts are far more important than anyone else's, because they have an impact, a real world impact on people's lives, how much we're spending, and of course fundamentally on growth as well. So my question is, if the fiscal demand multiplier was different, would your forecasts have been more accurate?
Not necessarily, no, I don't think so. If you, as I said, look, they're calibrated on the best data that we've got on the relationship between different forms of public spending and growth. For direct public spending, our demand multiplier is 1. Now, if you think it's bigger than that, then that means that the bigger your estate, the bigger your economy forever, and that just can't be right. And more generally, the relation, you saw a relatively big increase in public spending in the autumn budget, kind of raising the level of public spending, big increases in public sector pay. It's not evidently driving much more dynamic economic growth in the last few months, or indeed in the second half of last year. So we take a long view of these things. We try and estimate them off long-term relationships between different forms of public spending and tax and output and other measures. If that relationship is changed, we would change our multipliers. Okay. We've got demand multipliers and supply multipliers. They're based on the best evidence we can find.
Have you tested it?
I mean, we tested on the whole history of UK economic and fiscal policy. So yes.
Now, have you tested what happened if you change the demand multiplier? Would it be more accurate?
I mean, they're already estimated to be as accurate as they can be. I'm not quite sure. I know the answer.
Thank you. Alona McAvoy, MP.
Thank you, Chair. You mentioned quite a few times there that obviously your model is only as accurate as the data that you're putting into it. We've, as a committee, had quite a lot of time spent on the labour force survey and the ONS data. How much is that keeping you up at night, the reliability of this data?
So our forecasts are only as good as the outturn data on which they're based. And when that outturn data changes, we then have to sort of change our outlook, and that can also create instability for people who have to make policy on the basis of those forecasts. Yep. I have sympathy for all national statisticians in that there seems to be across advanced economies just kind of less participation in surveys, and so it's getting harder and harder to collect information in what has conventionally been the most reliable way to collect economic information from households and businesses, which is to ask them a load of questions. People don't answer their phone anymore. People don't answer the door anymore. But we do seem to have had we seem to have more of a problem with that in the UK than in other places, and we've struggled to. We've seen a bigger fall in response rates. We've struggled to get them back up again. I think and that just makes, when you're making big judgments about how big the labour force is, how many hours are people working, what are they earning, big ingredients to our forecast a problem. I think it's good and encouraging that the ONS are basically just like looking at the compliance burden of collecting data from the LFS, because it does seem to just take a very long time and takes a lot of people's time to collect that data, and thinking about other means of collecting data which is quicker and puts less of a compliance burden on the respondent. I think also just the general messages coming out of the ONS about focusing on the fundamentals around production of good macroeconomic statistics, possibly at the expense of some of the more innovative things which they have done, which I should say were very valuable, but nonetheless, you've got to get the kind of bread and butter right, and especially things on which the Bank of England's making decisions about interest rates, the government's making decisions about tax and spending policy. You really want to make sure that those are based on the best possible data that you've got, and that those are gold standard. And then other surveys about kind of how people are spending their time, which are interesting for kind of social researchers, also need to be done. And it's really important they respond to people's interest in those things. But it's possible that some too much attention got diverted into those latter things, and not enough was being focused on the bread and butter.
So how much would real-time PAYE, HMRC and DWP data support the work that you're doing to get a more accurate forecast, rather than, do you think you're overweighted on this, on the LFS?
I think for years now we've looked at a variety of indicators, and I think those things have the big advantage of being very timely, and you understand the population, right? Because they're on someone's payroll. I mean, the issue is what you don't know is then what's going on with everybody else, and so you have to kind of make guesses and infer about how big the self-employed population is, whether people are working informally and just not being picked up by these high-frequency data that just come out of very formal systems and direct from employers. So the nice thing about the labour force survey is it was just a random sample of the whole population, we thought, and so it was just like stopping the average person on the street and asking them about their employment status, and you felt more comfortable that you were picking up everybody who might possibly be in the population rather than just the people who are sitting on a formal payroll in a company. Now you have, if you just relied on that, you'd have to infer what's happening in the self-employed population.
Would you, if you had the HMRC data annually, would you still have to only infer, because HMRC will have the tax returns?
With a lag, right, because they'd be filling out self-assessment returns.
Okay.
So, and much of what we've been trying to figure out, especially in recent years, is, we had a pandemic, loads of people fell out of labour force. Were they coming back? When? How quickly? At what level of earnings? And so, because what you really want from these things is a sense of the dynamics. If you're waiting a full year to get self-assessment tax returns to understand, and you're only doing a 5-year forecast, that's a long time to wait to get a signal about what's going on right now, especially when we've seen big jumps in the participation rate and trying to figure out why that's going on. So in the end, we've looked at a variety of sources, including the LFS, but then appreciating its limitations, but then also picking up on these more real-time indicators.
And just final one from me on, obviously, we've heard quite a number of times about when it was flagged to government that the labour force survey was unreliable, and at what point did you start noticing, and did you flag to government that this data wasn't telling us a proper picture?
Quite early on. I mean, let me give you a very precise answer to that, which would involve me going back and checking my records. So let me come back to you. I mean, it was, to my recollection, we were still sort of recovering from the pandemic when it was obvious that response rates to the LFS were falling. So that, let me not rely on my imperfect memory, but let me just go back and give you a specific answer to that.
Thank you. Thank you very much. Yuan Yang MP.
Thank you, Chair. Mr. Hughes, I have some questions about external organisations' reflections on the OBR's work, some of which was published in external reviews this year. Firstly, Laura van Geest, your former counterpart at the Dutch fiscal watchdog, has written in an external review recommending that you focus more on highlighting uncertainty in your forecasts in a user-friendly manner. How would you implement this if reappointed?
So I should say we've just published our implementation plan to that external review, and it's been it's always been a valuable exercise for us. This is our third one. I think this one was especially valuable because it kind of came from a practitioner. The Dutch CPB has been around a lot longer than we have. They have a lot more experience of doing the kind of work that we do, and so it was particularly useful to get both kind of insights as well as some notes of caution from her about where to head next. Very much accept a recommendation on doing as much as we can to highlight uncertainty around our forecasts. I think this committee's seen how much we're at pains to produce fan charts, do scenarios, highlight areas. I mean, we published this whole green report on risks and uncertainty, and looking not just 5 years ahead, but 50 years ahead, and where the world might go and what would happen on a different trajectories. So we try and use as many different tools as we can to highlight uncertainty. In the end, the government has a fiscal rule which is either met or not met on the basis of our central forecast, which the law requires us to produce. And it is an interesting question to answer, right? It's like, is the government on track to meet its fiscal rules or not? One of the things which we always try and do is highlight whatever margin there is against that achievement. Is that a big number or a small number? And how does it compare to the average level of uncertainty around any forecast we produce for all the reasons that we've discussed, as well as kind of what are the known unknowns in our forecast? So in the last forecast we did back in March, for example, we knew interest rates had been highly volatile, we got lots of debt. We knew trade policy was rapidly changing, and a week later Donald Trump announced loads of tariffs on the world. And we knew our assumptions on productivity were very uncertain, so we made sure that our forecast included scenarios at all three of those things, so that we could just say, look, 10 billion sounds like a lot of money. It is a very small amount of money when you compare it to any one of those risks, and then even smaller if you compare them in combination.
And unfortunately, despite those efforts, there's still tremendous political and media pressure around the point estimates of headroom. The IMF has made a recommendation of de-emphasising those point estimates in your assessment of rule compliance. Now, obviously, that also that speaks not to something that's directly within your remit in terms of the laws that you have to follow. But what would your advice be to the lawmakers on this committee around following through with that particular IMF recommendation?
So, one thing that we do is not just report whether the government's current budget is, in surplus, balance, or deficit in 5 years' time, but give probabilities around that. The sad news is that those probabilities are never higher than the high 50s. So usually it's kind of roughly even chance of meeting this thing or not, because the government just runs its public finances really close to the wire, and it has done for years now. In the 2010s, governments would run very large amounts of headroom against their targets, and so could absorb lots of risk. More recently, they just haven't. And probabilities bring that to light, which is, there's a huge fan of uncertainty around the forecast for the current balance. The government is, right in the middle of that band, not toward, one of the safer extremes of it. So, but I think making use of those kind of fan charts and confidence intervals, I think, is useful and relevant in setting fiscal policy if you want to meet that target with confidence, given what we know about the distribution of risks around them. I mean, there are features in the current framework which have been built in but don't come into effect for a number of years, which are around having ranges around that number for particular forecasts, which give the government a bit more flexibility around exact balance, but allow them to be 0.5% either side of balance, which are also give the government a bit of leeway. But I still assume that this committee would be interested in the answer to, is the government on track to meet its fiscal rules on the central forecast or not, rather than a sort of a bunch of hand waving from me saying, well, it depends and who knows and the world is very uncertain. I mean, I get paid to answer that question, and I assume this committee wants me to answer it.
Do you think that how workable do you think that would be to change the binary yes/no? Will we meet this rule or not question to a confidence interval? That would obviously require.
Oh no! I mean, we already do it. It's in the book. I think it's 50-something%, but I mean, we already answer that question in probabilistic terms.
I mean, for the actual rule to track the confidence interval rather than the binary.
I mean, if a chancellor could, a government could express its rule in probabilistic terms and say, we want to not just meet the current budget by 1 penny, but we want to meet it with 60% confidence, and then that would then have to be calibrated off the risks around the forecast and the distribution of errors.
And the second IMF recommendation was to only formally assess the fiscal rules once a year at the time of the budget. Obviously, that would also require legislation. What's your view on that, and what's your advice to lawmakers on that? So
I guess it's important to say that the IMF was, as I understand it, the IMF's recommendation was that there be one assessment of the rules in the autumn, but still 2 official forecasts produced by the OBR, and that they continue to think that doing 2 forecasts a year is international good practice, and I think their more detailed staff report will set that out. From my point of view, the UK has been doing 2 economic forecasts and fiscal forecasts a year since 1975. Every other advanced economy also does 2 forecasts a year. So were we to reduce the number of forecasts to 1, that would make us one of the least fiscally transparent countries in Europe and of any major advanced economy. And so, but I think what the IMF was getting at was that, could you make that assessment happen in the autumn, and then if in the spring the government were off track for meeting its fiscal rules, kind of let it ride and make more policy decisions in the autumn? I mean, the government has that option now. And they've always had that option. And there have been times in the past when previous governments have been missing, one of their fiscal rules in a particular forecast and didn't take policy action to deal with it. So that option is already available to government. It just depends on how government reacts to the piece of news. Yeah. And there do seem to be elements of the fiscal framework, which, as I said, do come in a few years' time, which give government a bit of flexibility around the spring forecast, which is they can be up to 0.5% of GDP out from fiscal balance in the spring, but they have to kind of make it up in the autumn budget, and that's a way of focusing fiscal decision making then. I mean, in principle, that option is available to them now. They can just say, we're not bidding up fiscal rules in the spring, we'll get back to it in the autumn with how to do it.
So is your view, because the IMF is trying to deal with this tendency of fiscal tinkering around both forecasts, is your view that the OBR can carry on with those 2 forecasts a year so long as the government kind of looks through the second forecast in the spring and makes all the changes it needs in the autumn rather than responding immediately?
I mean, how governments react to how they're performing against their own fiscal rules is a matter for the government. Governments have missed their rules in the past, they have changed their fiscal rules in the past, and how much leeway governments give themselves against their fiscal rules is entirely a decision of the government. The reason why recently policy has been very responsive to changes in our forecast is because the world has been very volatile, and the government has left themselves hardly any room for manoeuvre against the achievement of their rules. So if you run the public finances really close to the wire, a very small change in the outlook for inflation, interest rates, growth or employment can put you the wrong side of that. And if you do want to meet your fiscal rules, which as I say is entirely a choice of the government, previous governments have not, or they've changed them, then governments adjust policy. But governments have lots of other choices about what they want to do in those circumstances.
My last question is from the Institute for Government's reflections on the IMF's recommendations there. The Institute for Government describes the kind of the media obsession with the headroom target as what seems to be uniquely British in their words. I was wondering if you had a view on the institutional culture and the institutional setup that we have in the UK. You've mentioned the low amount of headroom, but all governments around the world are facing economic volatility in global markets and in their forecasts, and to some extent in their debt markets as well. Do you see this as a uniquely British obsession?
We've had, I'll say a few things. One is that we've had fiscal rules for longer than most countries. We almost practically invented these things in the late 1990s.
The half-life is dramatically.
Yeah, well, exactly. We've had a fiscal rule. We've had a fiscal rule since the late 1990s. We've had 9 or 10 specific fiscal rules since then, which comes back to my point about governments change them all the time if that's what they want to do. And so I think to some extent rules-based fiscal policy making is very well established in this country, and everybody just expects a new chancellor to have a new set of fiscal rules and articulate them very clearly. And we've set out in legislation that one of the reasons why the OBR was set up was to assess whether governments are on track to meet them. In other countries like the US, they're not really bothered with fiscal rules, right? They've got a debt ceiling which everyone knows doesn't work and just repeatedly gets raised because having a nominal limit on debt is meaningless unless at some point you decide to default on it or make dramatic changes in tax and spending to deliver it. So you've got other countries in the G7 where fiscal rules don't exist, and so there's nothing to measure headroom against. And then in other countries in Europe, you've got fiscal frameworks, a number of which derive from European directives and treaties. A bunch of European countries are just meeting them with very large headroom. And so this issue doesn't arise because they are meeting their fiscal rules by considerable measure. And so they don't have to respond to what's the margin against the limit because they're miles from it. Their budgets are in balance and they've got limits up to 3% of GDP. And then in other cases, they're far above them. And so, Greece is not getting back to 60% of GDP worth of debt anytime soon. So the discussion about fiscal policy making is where are we on this very long journey of trying to get our public finances back to sustainability? I think in the UK, because you've got rules that are allied, that are chosen by chancellors, and therefore quite closely connected to the specific decisions that they make, and that chancellors like to meet and be seen to meet. I think that they get much more attention here than in other places for those reasons.
Thank you very much.
Thank you very much. Thank you, Chair.
Bobby Dean MP.
Thank you, Chair. So it seems you're saying that there's a wide range of fiscal rule possibilities out there that the markets will swallow. But I guess the argument put forward by this government is that we need to have very strict adherence to relatively tight rules, at least when you're looking at the revenue side, and trying to make that work with this volatile environment is creating policy problems for the government. I think people would assume that the process should be that the government creates a policy, the OBR assesses it, there's an exchange and then there's a forecast. But I guess the concern now is that the OBR forecasts are kind of driving policy creation, and I think the example of that people would give is what happened with the welfare reforms initially, which was seemingly trying to chase that £9.9 billion headroom. And so do you think that culturally, and not just from government policy perspective, but from a media narrative perspective, people need to have more allowance in their attitude towards fiscal rules in this volatile global economy?
So I think if you look at the rules that the government has in place at the moment, they're about as loose as we've had. balancing the current budget in 5 years' time, well, that already leaves out investment. So you're just balancing day-to-day spending against current spending in 5 years' time, and you're trying to get a measure of the balance sheet which is allows debt to keep rising, but so long as you're building up financial assets, can still fall. So, that is a reasonably permissive fiscal regime compared to ones that we've had in the recent past and compared to those that are in place in other countries. What I think leads policymaking to be very sensitive to changes in forecasts is what I came back to, which is that you've got a relatively permissive set of fiscal rules by historical standards, and governments running fiscal policy all the way up to the wire, all the way up to the line that they set for themselves. And I don't really accept the characterization that it was our forecast that sort of forced the government to make any particular set of policy decisions. Back in March, the government decided to make £5 billion worth of welfare savings. They had £10 billion worth of headroom against their fiscal rule. They could have settled for 5.
The perception emerged though because the changes came quite late in the day, and presumably they were already in discussions with you at this point, so had an idea of maybe where the direction of travel was. And it seems to me that they made an active decision to try and meet the £9.9 billion headroom again and keep that consistent. It seems quite remarkable out of a £1 trillion budget that they would arrive in that figure by accident. And so therefore that people will have got legitimate concerns that that's now driving policy making as opposed to the other way around.
But that's a choice for chancellors. As I said, chancellors can make a point about how much headroom they want against their fiscal rules. Recently they've left themselves very little. The Chancellor at the time of the March budget decided that she apparently wanted to maintain the £9.9 billion worth of headroom that she had back in the autumn. She could have settled for less and not done the welfare reforms. That was entirely a political choice that was available to her. She could have not done the welfare reforms and met her fiscal rules with our forecast. And so I don't really see how it was our forecast that somehow drove that decision on welfare. She's also got £1.5 trillion worth of choices about other spending and £1.5 trillion worth of choices about the tax. And she chose the ones that she chose back in March to get to a particular configuration for the fiscal rules, which overachieved where she needed to be, strictly speaking. And as I said, she's also got the choice of not meeting the rules and doing so at a later date or changing the rules.
Thank you. Thank you very much, John Grady.
Yes, thank you very much, Dame Meg. A short question from me. The purpose of the OBR is to provide independent supervision, if you like, of the public finances. But there are some people, including in this place, who say we need to get rid of the OBR altogether. So for a reappointment hearing, you might not want to hear that. But the outcome of having an independent supervision is presumably confidence for people who lend to the United Kingdom. And what you outlined earlier in your report is that we're losing a big buyer of gilts over the next 50 or so years in the form of DB schemes. So we've got to find some other buyers. So what would you say to people who say the OBR should be abolished?
When I read the legislation which you passed setting us up, it gives us 2 jobs. One is to provide the forecast the government uses to make policy, and the other is to provide you with information that you want about the state of the public finances, its outlook, and whether the government's meeting its fiscal choices and how those affect the forecast. And at the OBR, we take both of those responsibilities very seriously. I think, as you said, it has a sort of added benefit of providing some confidence to people who buy government debt and invest in UK gilts, which at any point in time is a choice. No one is forced to buy government debt, not even pension funds. If they don't want to, they can find a better asset. So I think our forecasts also serve serve the role of providing information that creditors are interested in when they're looking at the outlook for buying government debt. And maintain that confidence is important. I think we've had lived experience of a point in time in the autumn of 2022 when the government announced significant fiscal policy changes without an economic and fiscal forecast from us or anyone. And there was a loss of confidence in that government's fiscal policy. And that was reflected in the cost of government debt.
Thank you.
Thank you, Dame Meg.
And you, in your questionnaire, you talk about how you've had to demonstrate your independence, and you're clearly demonstrating your robustness in this session. You talked about asking your non-executive members to review and report publicly on any instances in which questions are raised about the integrity of the forecast process, and you've done that a couple of times, including in March 24. And and in both cases, all recommendations have been acted upon. But it is notable that the Prime Minister was at the liaison committee and was critical of you for not scoring. You record all contacts with ministers on both sides. Did you have any contact with the Prime Minister after that?
No, I've never met the Prime Minister.
Right, you've never had a meeting with the Prime. Okay, that's useful to know as well.
If I had, I would have logged it and informed you.
Yeah, okay, well, we'll keep an eye on the log list from now on. Maybe that's a little prompt to the Prime Minister to have a meeting with you, Mr. Hughes, if you are reappointed today. And you also talk about the OBR staff. You would inform your non-executive members and this committee in the event that any undue pressure is placed on you or the committee to behave in a manner that contradicts your legal duties. You haven't informed us of that, but have there been any attempts or forays into trying to push you in any particular direction?
There's not, but I would really emphasise that one of the reasons why I think there hasn't been is because of that precise proviso, which is that if there were, I would inform you.
You have to tell us.
And I would inform you immediately. And as I have in recent instances, including around the issues around Dell forecasts a little while back, where there were issues that we felt we needed to look into, we immediately informed this committee that work is underway, told you what review is underway, and then reported back to you on how it's improved. So this committee is a really important safeguard of both a good forecasting process, but also our independence, because we know that we have people that we can come to who value the role that we play, independent of the support we provide to government in putting together fiscal policy, who support the case for transparency and integrity that we can come to if those instances happen. I think perhaps because that backstop is there, I've never in my 5 years of the OBR come under pressure.
Right, when that's a nice compliment to the committee that's just about to adjourn to consider your reappointment, of which I would just repeat to anyone watching, we do actually have a veto. So, but can I thank you very much for your time today and for the last 5 years. We are about to have a conversation on the basis of the last 5 years, but also this last half hour or so to discuss whether to say to the Treasury that we could consider you should or should not be reappointed. So if you could step outside for a moment, we'll be in touch momentarily. Thank you very much indeed. Order.